Hey everyone, welcome back to the channel. This is a big one today, so let's get right into it. This is our fourth and final mini test on Enrolled Agent Exam. Part 1, Individuals 2026-27, covering Domain 1, Preliminary Work and Taxpayer Data. We've come a long way in this domain, from ITINs and filing deadlines to estimated tax penalties and safe harbor rules. Today we are wrapping up Domain 1 with 30 questions covering some of the most detail heavy topics on the exam. Backup withholding for non-resident aliens, the Statute of Limitations for refunds and IRS assessments, filing requirements for dependents, self-employed individuals and seniors, innocent spouse relief, separation of liability relief, equitable relief, injured spouse allocation, the IRS Lookback Rule, and even criminal tax evasion concepts. This is a long, rich session, so grab your notes and get ready. And here's some exciting news. Since this wraps up Domain 1 completely, our next test is going to be a bit different. We are moving into a full mixed syllabus practice test covering all of Part 1, 100 questions pulling from every topic across the entire syllabus. So if you've been following this series, that one's going to be a great way to test your overall readiness. As always, don't just sit back and listen. Pause after each question and its S. Work through it yourself. And then check your answer against mine. That's the real way to test your preparation. Alright, let's dive right into question 61. Question 61. Here's the scenario. In 2025, Lars is a citizen and resident of Sweden who occasionally visits the United States for holiday. He does not hold a green card and is classified as a non-resident alien for US tax purposes. Lars holds several US investments, including corporate stocks, in an account with Liberty Peak Brokerage. The brokerage formally requests that Lars provide an individual taxpayer identification number ITIN to certify his foreign status and manage his account. If Lars fails to provide a valid tax identification number, what standard statutory withholding rate must the brokerage apply to his US source investment income? A 15%, B 20%, C 24%, D 30%. The correct answer is D, 30%. Under IRS rules for non-resident aliens, US source fixed, determinable, annual or periodical FDP income, such as dividends and certain investment earnings, is generally subject to a flat 30% tax rate, often referred to as Chapter 3 NRA withholding. While international tax treaties can often reduce this withholding rate, a foreign investor must provide a valid Form W-8BEN containing a US taxpayer identification number, such as an ITIN, to formally claim any treaty benefits or prove their foreign status. If the non-resident alien fails to provide an ITIN to the US withholding agent, the brokerage firm, the agent is legally required to withhold taxes at the maximum statutory rate of 30% on all US source income to ensure the tax liability is fully covered. Great, now let's move to our next question. Question 62. What is the standard statute of limitations RSED for claiming a tax refund via an amended return? A. 2 years from the date the return was filed or 1 year from the date the tax was paid, whichever is later. B. 3 years from the date the return was filed or 2 years from the date the tax was paid, whichever is later. C. 5 years from the date the return was filed. D. 7 years from the date the return was filed. The correct answer is B. 3 years from the date the return was filed or 2 years from the date the tax was paid, whichever is later. The refund statute expiration date RSED allows taxpayers to claim a refund by filing an amended return within 3 years from the date the return was filed, or original due date if filed early, or 2 years from the date the tax was paid, whichever is later. Great job so far. Let's keep the momentum going with question 63. Question 63. Here's the scenario. Leonard, age 67, and Miriam, age 66, are married and will file a joint tax return for the 2025 tax year. During 2025, Miriam had a total income of $22,000, consisting entirely of Social Security benefits. Leonard worked part time and earned $15,500 in wage income. They had no other sources of income. Which of the following statements is correct regarding their requirement to file a 2025 US individual income tax return? A. Required to file because their combined income of $37,500 exceeds the $34,700 threshold. B. Not required to file because their $15,500 gross income is below the $34,700 threshold. C. Required to file because Leonard's wages alone trigger a mandatory filing requirement. D. Not required to file because their $15,500 gross income is below the $31,500 threshold. The correct answer is B. Not required to file because their $15,500 gross income is below the $34,700 threshold. Under IRS rules for 2025, a married couple filing jointly, where both spouses are 65 or older, must file a tax return if their gross income is at least $34,700. The standard deduction of $31,500 plus $1,600 for each spouse over 65. Gross income includes all taxable income, but generally excludes Social Security benefits unless half of those benefits plus all other income exceeds the $32,000 base amount for joint filers. Because half of Miriam's Social Security, $11,000, plus Leonard's wages, $15,500, equals $26,500. None of the Social Security is taxable. Therefore, their gross income for filing purposes consists entirely of the $15,500 in wages, which falls well below the $34,700 threshold, exempting them from the filing requirement. Fantastic! Let's move on to question 64. Question 64. What is the extended statute of limitations period for amending a tax return to claim a refund for losses from worthless securities or bad debts? A. 3 years, B. 5 years, C. 7 years, D. 10 years. The correct answer is C. 7 years. The IRS allows a unique extended statute of limitations of up to 7 years prior for taxpayers amending a return to claim a refund based on bad debt from worthless securities. Perfect. Let's move ahead to question 65. Question 65. Here's the scenario. In 2025, Juliana works as an independent contractor, providing virtual assistant services and has no other income. Regardless of whether her overall gross income is below the standard deduction, Juliana is legally required to file a 2025 tax return if her net earnings from self employment meet or exceed what specific amount? A. $1, B. $600, C. $400, D. $1,250. The correct answer is C. $400. Under IRS rules for 2025, an individual is legally required to file a federal income tax return if their net earnings from self-employment are $400 or more for the tax year. This specific threshold triggers the requirement to file Schedule SE and pay self-employment tax, which consists of Social Security and Medicare taxes, even if the taxpayer's overall gross income is lower than the standard deduction amount required to owe regular income tax. Net earnings are calculated by subtracting allowable business expenses from gross self-employment income, and hitting the $400 mark creates an automatic filing obligation. Great. Let's continue to question 66. Question 66. How long is the statute of limitations CSED for the IRS to collect unpaid taxes once they have been formally assessed? A. 3 years from the date of assessment. B. 6 years from the date of assessment. C. 7 years from the date of assessment. D. 10 years from the date of assessment. The correct answer is D. 10 years from the date of assessment. The collection statute expiration date CSED gives the IRS a 10-year period to collect unpaid taxes. This 10-year statute of limitations begins running on the date the tax is formally assessed. Great. Moving on to question 67. Question 67. Here's the scenario. In 2025, Gregory, age 68, and Fiona, age 67, are married but have chosen to file their tax returns as married, filing separately. During the year, Gregory earned $22,000 in wages and Fiona earned $800 from a part-time job. Under 2025 IRS rules, what is the minimum gross income threshold that triggers a mandatory federal income tax filing requirement for a taxpayer using the married filing separately status? A. $5. B. $400. C. $1,600. D. $15,750. The correct answer is A. $5. Under standard IRS rules for the 2025 tax year, the gross income filing threshold for any taxpayer whose filing status is married filing separately is exactly $5. This incredibly low threshold applies regardless of the taxpayer's age or whether they are blind, because both Gregory and Fiona have individual gross incomes that equal or exceed $5. They are both legally required to file their own separate federal income tax returns for the year. Awesome, let's move to question 68. Question 68. Here's the scenario. In 2025, 12-year-old Lucas lives with his father and is claimed as a dependent. Lucas receives interest and dividend income from a family trust set up by his late grandparents. He has no earned income from a job. What is the maximum amount of unearned investment income Lucas can receive in 2025 without triggering a federal income tax filing requirement? A. $1,250. B. $1,300. C. $1,350. D. $2,700. The correct answer is C. $1,350. For the 2025 tax year, a dependent child whose gross income consists entirely of unearned income, such as interest, dividends, or capital gains, is legally required to file a tax return only if that unearned income exceeds the base standard deduction amount for dependents. The IRS inflation adjusted threshold for the dependent standard deduction for unearned income in 2025 is $1,350. As long as Lucas's total unearned income is $1,350 or less, He is not required to file an individual income tax return and does not trigger the kiddie tax rules, which begin applying to unearned income over $2,700 in 2025. Great, let's move forward to question 69. Question 69. Here's the scenario. In 2025, 16-year-old Oliver Bennett lives with his parents and qualifies as their dependent. During the year, Oliver earned $4,000 in wages from a summer job at a local grocery store, which withheld federal income tax from his paychecks. He also received $300 in interest income from a high yield savings account. Which of the following statements is correct regarding Oliver's federal income tax filing requirement for the 2025 tax year? A. He must file a return because his total gross income exceeds $1,350. B. He must file a return to report his investment income for the kiddie tax. C. He cannot file a tax return because his parents claim him as a dependent. D. He is not required to file but may choose to do so to claim a tax refund. The correct answer is D. He is not required to file but may choose to do so to claim a tax refund. For the 2025 tax year, a single dependent must file a tax return if their earned income exceeds $14,600, their unearned income exceeds $1,350, or their total gross income exceeds the larger of $1,350, or their earned income plus $450 up to $14,600. Oliver's unearned income of $300 is well below the $1,350 unearned income threshold. Furthermore, his total gross income of $4,300 is less than his allowable dependent standard deduction of $4,450. $4,000 earned income plus $450. Because he does not meet any of the thresholds, he has no legal requirement to file a federal income tax return. However, because federal income tax was withheld from his summer wages, Oliver may voluntarily file a return to receive a refund of those withheld taxes. Fantastic. Let's move on to question 70. Question 70. Here's the scenario. Isabella is a 19-year-old full-time college student who is claimed as a dependent on her parents' tax return. During 2025, she worked part-time at a local coffee shop and earned $16,200 in wages. She had no other sources of income. Under 2025 IRS rules, what is the exact minimum amount of total earned income that triggers a mandatory federal income tax filing requirement for a single dependent like Isabella? A. $1,350. B. $2,700. C. $15,300. D. $15,750. The correct answer is D. $15,750. For the 2025 tax year, a single individual who can be claimed as a dependent by another taxpayer is legally required to file their own federal income tax return if their total earned income strictly exceeds the standard deduction for single filers, which is $15,750. Because Isabella's earned wage income of $16,200 surpasses this threshold, she has a mandatory filing requirement. Even though she must file a return, her income is not subject to the kiddie tax, which only applies to unearned investment income, and her parents can still legally claim her as a qualifying child dependent because she is a full-time student under the age of 24. Great, let's continue to question 71. Question 71. Here's the scenario. Arthur is a 68-year-old single retiree with no dependents. In 2025, he receives $16,000 in Social Security benefits. To stay active, he also operates a small weekend landscaping business, earning a net profit of $900 for the year, for which he received a Form 1099-K. His overall gross income is well below the standard 2025 filing threshold of $17,750 for a single taxpayer aged 65 or older. Which of the following statements is correct regarding Arthur's requirement to file a 2025 federal income tax return? A. Not required to file because his gross income is below $17,750. B. Required to file because his net self-employment earnings are $400 or more. CE. Not required to file because his standard deduction completely offsets his income. D. Required to file because receiving any Form 1099-K automatically mandates filing. The correct answer is B. Required to file because his net self-employment earnings are $400 or more. Under IRS rules for the 2025 tax year, most taxpayers are only required to file a return if their gross income exceeds their specific standard deduction threshold, which is $17,750 for a single filer aged 65 or older. However, a special statutory filing requirement is triggered for any individual whose net earnings from self-employment are $400 or more. Because Arthur's net self-employment income of $900 from his landscaping business surpasses this $400 minimum threshold, he is legally required to file a federal income tax return to report his business earnings on Schedule C and calculate his self-employment tax on Schedule SE regardless of his age or the fact that his overall gross income is lower than the standard filing threshold. Great, let's move on to question 72. Question 72. Here's the scenario. Nadia Patel is 28 years old and earns $14,000 in W-2 wages from a part-time retail job in 2025. Typically, she would not meet the minimum filing requirement, but she also earns $550 in net income from occasional freelance photography gigs during the year. She intends to continue this photography work for profit in the future. Although her photography clients paid her in cash and she did not receive any 1099 tax forms, which of the following correctly describes Nadia's 2025 federal income tax filing requirement? A. Not required to file because her total gross income is under $15,750. Be required to file only if she is issued a Form 1099 NEC for her work. C. Required to file because her net self-employment earnings are $400 or more. D. Not required to file because her standard deduction completely offsets her tax. The correct answer is C. Required to file because her net self-employment earnings are $400 or more. Under 2025 IRS rules, a single taxpayer under the age of 65 is generally not required to file a federal income tax return if their total gross income is below the standard deduction of $15,750. However, there is a special statutory filing requirement for individuals who earn self-employment income, regardless of their overall gross income or whether they receive informational tax documents like a Form 1099 NEC. Any taxpayer with net earnings from self-employment of $400 or more is legally required to file a tax return. Because Nadia's freelance photography earnings of $550 surpass this $400 threshold. She must file Form 1040 and attach Schedule C to report her business income, as well as Schedule SE to calculate her self employment taxes. Great, let's move to question 73. Question 73. Here's the scenario. Vance Sterling is 41 years old and single. During 2025, he earned $13,500 in wages from a part time job. Because his gross income is below the $15,750 standard deduction threshold for single filers, he normally would not have a filing requirement. However, he withdrew $2,500 from his traditional IRA early in the year to pay for unexpected car repairs. Which of the following statements is correct regarding Vance's federal income tax filing requirement for the 2025 tax year? A. Required. The early IRA distribution subjects him to an additional tax. B. Not required. His total income is below the $15,750 standard deduction. C. Required. Any unearned income over $400 automatically triggers a return. D. Not required. IRA distributions are completely exempt from gross income. The correct answer is A. Required. The early IRA distribution subjects him to an additional tax. Under 2025 IRS rules, a single taxpayer under age 59 and a half whose gross income is less than their standard deduction, $15,750, generally does not need to file an income tax return. However, a filing requirement is automatically triggered if the taxpayer owes any special taxes. Because Vance is under age 59 and a half, his $2,500 withdrawal from a traditional IRA is considered an early distribution, which subjects him to a 10% additional tax. Owing this specific penalty legally requires him to file a federal income tax return, Form 1040, and attach Form 5329 to report the additional tax, regardless of the fact that his overall gross income is lower. Question 74. Here's the scenario. Valerie is 35 years old, unmarried, and provides the sole support for her 7-year-old daughter, qualifying her for the head of household filing status in 2025. During the year, she earned $15,000 in W 2 wages from a medical office and an additional $600 in net income from an independent weekend house cleaning business. Her total gross income of $15,600 is well below the 2025 standard deduction for a head of household, $23,625. Which of the following statements is correct regarding Valerie's 2025 federal income tax filing requirement? A. Not required to file since her total income is below the $23,625 standard deduction. B. Required to file because claiming a qualifying child mandates an annual tax return. C. Required to file because her net self employment earnings are $400 or more. D. Required to file because her W 2 wages exceed the single dependent threshold. The correct answer is C. Required to file because her net self employment earnings are $400 or more. Under 2025 IRS rules, a taxpayer qualifying as head of household is generally not required to file a federal income tax return if their gross income falls below the applicable standard deduction, $23,625. However, a special statutory rule triggers a mandatory filing requirement for any individual whose net earnings from self-employment are $400 or more, regardless of their overall gross income. Therefore, Valerie's $600 in net self-employment income legally requires her to file a return. Furthermore, even if Valerie did not have the self-employment earnings and was legally exempt from filing based on her W-2 wages alone, she should still file a return. Her earned income and qualifying dependent make her eligible to claim valuable refundable tax credits such as the Earned Income Tax Credit EITC and the Child Tax Credit CTC, which could result in a sizable tax refund. Great. Let's continue to question 75. Question 75. Here's the scenario. For the 2025 tax year, Josephine and Elias filed a joint federal income tax return. They finalized their divorce in late 2026. In January 2027, the IRS sent a notice to Josephine stating that a substantial amount of additional tax is owed for the 2025 tax year because Elias secretly liquidated a separate investment account and intentionally failed to report the profits. Josephine had absolutely no knowledge of this account, the transaction, or the hidden money during their marriage. To request that she not be held personally liable for the tax on Elias's unreported income, which specific form must Josephine file with the IRS? A. Form 8379 Injured Spouse Allocation. B. Form 8857 Request for Innocent Spouse Relief. C. Form 1040X Amended U.S. Individual Income Tax Return. D. Form 8879 IRS E-File Signature Authorization. The correct answer is B. Form 8857 Request for Innocent Spouse Relief. When a married couple files a joint income tax return, both spouses are generally jointly and individually responsible for the entire tax liability, even if they later separate or divorce. However, under IRS rules, a taxpayer can seek relief from additional tax owed if their spouse or former spouse failed to report income or claimed improper deductions, provided the requesting spouse can prove they had no knowledge of the errors and it would be unfair to hold them liable. To request this relief, the taxpayer must file Form 8857 Request for Innocent Spouse Relief. Form 8379 Injured Spouse Allocation is incorrect in this scenario as it is strictly used when a taxpayer's portion of a joint tax refund is seized to pay their spouse's legally enforceable past due debts, not to dispute a new tax liability caused by a spouse's unreported income. Alright, we've covered 15 questions so far. Great job staying focused through some really detail heavy material. Just a quick note here, since this is our last Domain 1 test. If you want structured, chapter wise practice for every topic in part 1, exactly like what we've been covering across these sessions, you can go with my ebook. It's got detailed practice questions organized chapter by chapter so you can strengthen each topic at your own pace before we move into the full mixed syllabus test. Link is in the description if that's useful for you. Alright, let's get back into it. On to question 76. Alright, let's get back into it. On to question 76. Question 76. Here's the scenario. In 2023, Larry and Priscilla filed a joint federal income tax return. They finalized their divorce in February 2025 and now live in separate residences in Texas. In October 2025, the IRS audits their 2023 return and discovers that Priscilla claimed $28,000 in improper deductions for her separate interior design business, resulting in a substantial tax deficiency. Larry had no involvement in her business and no actual knowledge of the fraudulent deductions when he signed the return. He files Form 8857 to request separation of liability relief. If the IRS approves his request, how will the tax deficiency be handled? A. The IRS will require Larry to pay exactly 50% of the total tax underpayment. B. The IRS will forgive the entire tax debt for both taxpayers due to the divorce. C. The IRS will allocate the tax understatement as if they had filed separate returns. D. The IRS will hold Larry fully liable because he signed the original joint return. The correct answer is C. The IRS will allocate the tax understatement as if they had filed separate returns. When taxpayers file a joint return, they are generally both held jointly and individually responsible for the entire tax liability, even after a divorce. However, a divorced or legally separated taxpayer can file Form 8857 to request separation of liability relief. To qualify, the requesting spouse must prove they are no longer married to or living with the spouse with whom they filed the joint return for the 12 months prior to filing the form, and they must establish that they had no actual knowledge of the erroneous items, such as the improper business deductions, at the time the return was signed. When this specific relief is granted, the IRS divides the additional tax owed based on each person's actual contribution to the tax understatement, allocating the liability exactly as if the two individuals had filed separate tax returns for that year, thereby protecting the unaware spouse from the other's tax debt. Great. Let's move forward to question 77. Question 77. Here's the scenario. In early 2025, the IRS audits a prior year joint tax return filed by Eleanor and her husband, Finn, discovering a large tax deficiency due to Finn's deliberately underreported business income. When Eleanor signed the return, she had actual knowledge that the income was underreported. However, Eleanor was a victim of severe domestic violence and only signed the return because she feared physical retaliation from Finn if she questioned him or refused. Eleanor is now living apart from Finn and files Form 8857 to request relief from the joint tax debt. How will the IRS treat Eleanor's actual knowledge of the understated tax? A. She is permanently disqualified from any relief because she knew about the omitted income. B. She will only qualify for injured spouse relief to protect her future tax refunds. C. She must pay 50% of the tax due, but the IRS will waive all associated fraud penalties. D. She may still be granted equitable relief because the abuse establishes she signed under fear. The correct answer is D. She may still be granted equitable relief because the abuse establishes she signed under fear. Under standard IRS rules, if a taxpayer has actual knowledge of an understated tax, such as knowing about a spouse's unreported income or false deductions, when they sign a joint return, they are generally disqualified from innocent spouse relief and separation of liability relief. However, the IRS provides a specific exception for victims of domestic violence and spousal abuse. If the requesting spouse can establish that they were a victim of abuse prior to signing the return and that they did not challenge the erroneous items on the tax return because they feared physical or economic retaliation from their spouse, the IRS can grant equitable relief. This exception allows the abused spouse to be relieved of the tax liability, penalties, and interest, even though they had actual knowledge of the errors when the joint return was filed. Fantastic! Let's move on to question 78. Question 78. Here's the scenario. In 2025, Jake and Bailey got married and subsequently filed a joint federal income tax return. They were expecting a significant tax refund, but the Department of Treasury offset the entire amount to pay for Bailey's delinquent federal student loans that she acquired before they were married. Jake wants to recover the portion of the tax refund attributable to his own income and withholdings. Which form should Jake file with the IRS? A. Form 8379, Injured Spouse Allocation. B. Form 8857, Request for Innocent Spouse Relief. C. Form 1040X, Amended Tax Return. D. Form 8888, Allocation of Refund. The correct answer is A. Form 8379, Injured Spouse Allocation. When a married couple files a joint tax return and all or part of their refund is seized to pay a legally enforceable past due debt, such as federal student loans, state income taxes, or child support, owed by only one spouse, the non-debtor spouse is classified as an injured spouse. To protect and reclaim their specific share of the joint refund, the injured spouse must file Form 8379, Injured Spouse Allocation. It is critical for exam purposes to distinguish this from Innocent Spouse Relief, Form 8857. Form 8379 is used strictly to recover a seized refund, whereas Form 8857 is used to seek relief from a newly assessed joint tax liability caused by a spouse's errors or omissions. Great, let's continue to question 79. Question 79. Here's the scenario. Jasmine e-filed her 2021 federal income tax return early on February 12, 2022. In early 2025, she realizes she forgot to claim the American Opportunity Tax Credit for her college expenses, which would result in a substantial tax refund. Under the IRS Statute of Limitations, what is the absolute latest date Jasmine can file her amended return, Form 1040X, to successfully claim this refund? A. April 15, 2025. B. February 12, 2025. C. October 15, 2025. D. December 31st, 2025. The correct answer is A. April 15, 2025. Under standard IRS rules, a taxpayer must file a claim for a refund within 3 years from the date the original tax return was filed or within 2 years from the date the tax was paid, whichever is later. However, there is a specific statutory rule for early filers. Any individual tax return filed before the original unextended due date is legally considered to have been filed exactly on the due date. Because Jasmine filed her 2021 tax return early on February 12, 2022, her return is treated as if it were filed on the standard April 15th deadline. Therefore, her 3-year statute of limitations clock starts on that April deadline, giving her until April 15th, 2025 to file her amended return and successfully claim her refund. Excellent. Let's move on to question 80. Question 80. Here's the scenario. For the 2021 tax year, Donovan Pierce self-prepared his federal income tax return but filed it late on November 1st, 2022 without ever requesting an extension of time to file. Years later, he discovers he forgot to claim the earned income tax credit, which would result in a substantial refund of his withheld taxes. He files an amended return, Form 1040X, on October 10th, 2025. Although his amended return was filed within 3 years of his original filing date, the IRS denies his refund claim. Under IRS Statute of Limitation rules, why is Donovan's refund legally forfeited? A. He lost the right to amend his return because he filed the original return late. B. His withheld taxes were deemed paid outside the 3-year statutory lookback period. C. His amended return was filed more than 2 years from the original tax deadline. D. He cannot claim a refundable credit if the original return was delinquent. The correct answer is B. His withheld taxes were deemed paid outside the 3-year statutory lookback period. Under IRS rules, a taxpayer generally has 3 years from the date a return is filed to claim a refund, meaning Donovan's claim on October 10th, 2025 was technically filed within the 3-year window of his November 1st, 2022 filing date. However, a strict secondary statutory rule, the lookback period under IRC section 6511, restricts the amount of the refund. If a claim is filed within the 3-year period, the refund is legally limited to the tax paid during the 3 years immediately preceding the filing of the claim, plus the period of any valid extension of time to file. Donovan's 2021 withheld taxes were legally deemed paid on the original unextended due date, April 18th, 2022. Because he filed his amended return on October 10th, 2025, his 3-year lookback period only reaches back to October 10th, 2022. Since his taxes were paid before this date and he had no extension to expand the lookback window, his allowable refund amount is legally limited to zero. Great. Let's move to question 81. Question 81. Here's the scenario. On March 1st, 2026, Gideon hires an enrolled agent to prepare and file his current year 2025 tax return, along with several years of delinquent tax returns 2020 through 2024. All of his returns show a refund due to excess W-2 wage withholding. Gideon never requested any filing extensions for any of the prior years. Based on the standard IRS Statute of Limitations, what is the oldest tax year for which Gideon will legally be permitted to receive his tax refund? A 2019, B 2020, C 2021, D 2022. The correct answer is D 2022. Under IRS rules, to successfully claim a tax refund, a taxpayer must file a return within 3 years from the original due date of the return, and the allowed refund is strictly limited to the amount of tax paid within the 3-year period immediately preceding the date the claim is filed. For statute of limitation purposes, W-2 wage withholdings are legally deemed paid on the original unextended due date of the tax return for that specific year. Because Gideon is filing his delinquent returns on March 1st, 2026, his 3-year statutory lookback window only covers taxes deemed paid on or after March 1st, 2023. The unextended due date for his 2022 tax return was in April 2023, meaning those taxes fall safely within the 3-year window, allowing the IRS to issue the refund. However, his 2021 taxes were deemed paid in April 2022, which is outside the 3-year lookback period. Therefore, 2022 is the absolute oldest tax year for which he can legally receive his refund. The excess withholdings from 2021 and earlier are permanently forfeited to the US Treasury. Excellent. Let's move on to question 82. Question 82. Here's the scenario. Nathaniel Hayes timely filed his 2021 federal tax return on April 15th, 2022. He later discovers an omission that entitles him to a refund. Normally, his 3-year statute of limitations to file an amended return expires on April 15th, 2025. However, Nathaniel suffers a catastrophic medical event and is medically certified as financially disabled for a continuous period of exactly 10 months in 2025. No one else is authorized to act on his behalf in financial matters during this time. By how many months is Nathaniel's normal statute of limitations for filing a refund claim suspended under IRS rules? A 10 months, B 0 months, C 6 months, D 12 months. The correct answer is A. 10 months. Under IRS Section 6511, subsection H, the normal statute of limitations for filing a tax refund claim is suspended during any period in which an individual is considered financially disabled. A taxpayer is financially disabled if they are unable to manage their financial affairs due to a medically determinable physical or mental impairment that can be expected to result in death or has lasted or can be expected to last for a continuous period of at least 12 months. Assuming Nathaniel provides the required medical certification and no other person, like a spouse or guardian, is legally authorized to act on his behalf in financial matters. During this time, the statute of limitations clock stops for the exact duration of his disability. Therefore, his filing deadline is extended by the 10-month period he was financially disabled. Great. Let's continue to question 83. Question 83. Here's the scenario. In August 2025, Kramer is organizing his home office and finds a stack of unopened mail from his brokerage firm dating back several years. Upon reviewing the documents, he discovers a form 1099B from 2019 showing a $14,000 loss from a stock investment that went entirely bankrupt and became a worthless security during that tax year. Kramer never claimed this loss. Normally, his standard 3-year window to amend his 2019 return expired in 2023. Under IRS Statute of Limitation rules, what is the maximum number of years from the original unextended due date of the return that Kramer has to file an amended return to claim a refund specifically for a worthless security? A. 3 years. B. 7 years. C. 10 years. D. 15 years. The correct answer is B. 7 years. Under standard IRS rules, a taxpayer typically has 3 years from the date a return was filed or 2 years from the date the tax was paid to claim a refund. However, there is a special extended statute of limitations for overpayments resulting from the deduction of a bad debt or a loss from a worthless security. For these specific types of investment losses, the statute of limitations to file an amended return, Form 1040X, to claim a refund is legally extended to 7 years from the original due date of the return for the year the security actually became worthless. Therefore, Harrison has up to 7 years from his original 2019 tax deadline to file his claim and receive his refund. Great, let's move on to question 84. Question 84. Here's the scenario. Fiona E. files her 2025 federal income tax return early on February 20th, 2026. Assuming she did not commit fraud and did not omit more than 25% of her gross income, what is the exact date the standard IRS statute of limitations for assessing additional tax on this return expires? A. February 20th, 2029. B. October 15th, 2029. C. April 15th, 2029. D. December 31st, 2028. The correct answer is C. April 15th, 2029. Under standard IRS rules, IRC section 6501, the statute of limitations for the IRS to assess additional tax generally expires 3 years from the date the tax return was filed. However, a specific statutory exception applies to early filers. If an individual tax return is filed before the original unextended due date, which is April 15th, 2026, for the 2025 tax year, the return is legally treated as having been filed exactly on that April 15th due date. Because Fiona filed early on February 20th, the 3-year statutory clock does not begin ticking until April 15th, 2026. Therefore, the standard assessment period expires exactly 3 years later on April 15th, 2029. After this date, the IRS could only assess additional taxes if they could prove an exception to the 3-year rule, such as fraud, which has no time limit, or a substantial understatement of gross income exceeding 25%, which has a 6-year limit. Great. Let's move to question 85. Question 85. Here's the scenario. Ellsworth filed his 2025 federal income tax return reporting a total gross income of $120,000. However, he accidentally failed to report $35,000 in cryptocurrency gains, mistakenly believing they were not taxable until transferred to his traditional bank account. Because the omitted $35,000 exceeds 25% of the gross income stated on his return, this is legally considered a substantial omission of income. Under these specific circumstances, how long is the statute of limitations for the IRS to audit Ellsworth's 2025 return and assess the additional tax? A. 6 years. B. 3 years. C. 7 years. D. 10 years. The correct answer is A. 6 years. Under standard IRS rules, the agency generally has 3 years from the filing date of a tax return to audit and assess additional taxes. However, a specific statutory exception applies when a taxpayer makes a substantial omission of income. If an individual omits an amount from their gross income that is strictly greater than 25% of the total gross income actually stated on their tax return, the statute of limitations is legally extended. In this scenario, the IRS is granted 6 years from the date the return was filed to audit the return and assess any additional tax, penalties, and interest. Because Ellsworth's omitted income, $35,000, is more than 25% of his reported income, $30,000, the extended 6-year assessment period automatically applies. Excellent. Let's move on to question 86. Question 86. Here's the scenario. In 2025, Donald Thorne, a former independent contractor, suffers a permanent disability and can no longer work. He currently owes the IRS $45,000 from a formal tax assessment made on his account several years ago. Donald has no assets and can no longer afford to make payments on his installment agreement. Under standard IRS rules, what is the total statutory time limit from the date of the original assessment that the IRS has to legally collect this tax debt before the collection statute of limitations permanently expires? A. 3 years. B. 6 years. C. 10 years. D. 15 years. The correct answer is C. 10 years. Under standard IRS rules, IRC section 6502, the IRS generally has exactly 10 years from the date a tax liability is officially assessed to collect the unpaid tax, penalties, and interest. This 10-year deadline is known as the Collection Statute Expiration Date, CSED. If a taxpayer like Donald has no assets or disposable income to pay the debt, the IRS may temporarily classify the account as currently not collectible to halt active levies. But the 10-year statute of limitations clock continues to run. Once that 10-year collection period expires, the IRS permanently loses its legal authority to pursue collection actions, and the remaining debt is effectively deemed uncollectible and legally unenforceable, provided no specific taxpayer actions, such as filing for bankruptcy or submitting an offer in compromise, paused or tolled the statute. Great. Let's continue to question 87. Question 87. Here's the scenario. In 2025, 52-year-old Krista receives an IRS audit notice claiming she had unreported self-employment income for the 2019 tax year. Krista never filed a federal income tax return for 2019 because she genuinely believed her total income was below the filing threshold. Under standard IRS rules, when does the statute of limitations expire for the IRS to assess additional tax for a year in which a taxpayer completely fails to file a return? A. 3 years after the original unextended due date. B. 6 years after the original unextended due date. C. 10 years after the IRS issues the audit notice. D. There is no statute of limitations. It remains open indefinitely. The correct answer is D. There is no statute of limitations. It remains open indefinitely. Under standard IRS rules, the 3-year statute of limitations for the agency to audit and assess additional taxes only begins on the date a tax return is actually filed. If a taxpayer completely fails to file a federal income tax return for a given year, even if they genuinely but incorrectly believed they were not legally required to do so due to low income, the statute of limitations clock never starts ticking. Consequently, the assessment statute remains open indefinitely, granting the IRS the legal authority to audit the unfiled year and assess any applicable taxes, penalties, and interest at any time in the future. Great, let's move on to question 88. Question 88. Here's the scenario. In 2025, Marshall, an enrolled agent, prepares the federal income tax return for his client, Dr. Aris Thorne. After Marshall completes the return, Dr. Thorne reviews it to ensure all income and expenses from his dental practice are accurately reported. Regarding the signature requirements for this tax return, which of the following statements is legally correct? A. Only Marshall is required to sign the tax return. B. Both Dr. Thorne and Marshall are required to sign the tax return. C. Neither must sign if the return is electronically filed. D. Only Dr. Thorne is required to sign the tax return. The correct answer is B. Both Dr. Thorne and Marshall are required to sign the tax return. Under 2025 IRS rules, when a paid tax professional, such as an enrolled agent, prepares a federal income tax return, both the taxpayer and the paid preparer are legally required to sign the document. The taxpayer, Dr. Thorne, must sign to declare, under penalties of perjury, that the information provided on the return is accurate and complete to the best of their knowledge. Simultaneously, the paid preparer, Marshall, must sign in the designated paid preparer section and include their preparer tax identification number PTIN. This dual signature requirement is mandatory regardless of the filing method. It applies whether the tax return is submitted physically on paper with wet ink signatures or electronically filed using approved electronic signatures or practitioner pin methods. Great. Let's move to question 89. Question 89. Here's the scenario. In 2025, Alexander faces criminal charges for tax evasion after drastically underreporting his lucrative consulting income for several years. In his defense, Alexander argues that he was simply confused by the inherent complexity of the tax code and did not understand his obligations. However, the IRS presents documented evidence that Alexander had previously negotiated an installment agreement for prior tax debts, actively communicated with an accountant about his liabilities, and then deliberately routed payments into hidden accounts to avoid IRS collection. How will the court most likely view Alexander's defense of confusion in this tax evasion case? A. Valid, because the tax code's complexity legally excuses misunderstandings unless a paid preparer is involved. B. Invalid, because his prior actions and attempts to conceal assets demonstrate actual knowledge of his legal duty. C. Valid, because the government must prove strict liability regardless of his subjective intent or confusion. D. Invalid, because tax evasion charges do not require the government to prove willfulness or intent. The correct answer is B. Invalid, because his prior actions and attempts to conceal assets demonstrate actual knowledge of his legal duty. Under IRS rules, specifically IRC Section 7201, a conviction for criminal tax evasion requires the government to prove an affirmative act to evade taxes, a tax deficiency, and willfulness. In the context of federal tax law, willfulness is strictly defined as the voluntary intentional violation of a known legal duty, while a genuine good faith misunderstanding of the tax law can negate the element of willfulness. The cheek defense, a generalized claim of confusion, will be rejected if objective evidence shows the taxpayer actually understood their obligations. Because Alexander had previously set up an installment agreement and actively took steps to hide assets, his actions provide affirmative evidence that he knew his legal duty and deliberately chose to violate it, defeating his defense of confusion. Excellent. Now let's move to our final question. Question 90. Question 90. Here's our last scenario. Julie Vance requested an automatic 6-month extension to file her 2022 individual income tax return. The original due date was April 15th, 2023, and the extended due date was October 15th, 2023. Julie missed the extended deadline and filed her return late on October 28th, 2023. She had $2,000 in estimated tax payments deemed paid on April 15th, 2023. She paid an additional $600 when she filed her late return on October 28th, 2023. Later, Julie discovers a significant error and files an amended return claiming a full $2,600 refund on October 28th, 2026. Based on the IRS Lookback Rule, what is the maximum refund amount Julie is legally permitted to recover? A. $2,600, B. $2,000, C. $600, D. $0. The correct answer is C. $600. Under IRS rules, specifically IRC Section 6511, a claim for refund is timely if filed within 3 years of the date the return was actually filed. Because Julie filed her amended return exactly 3 years after her original late filing, October 28th, 2023 to October 28th, 2026, her claim is procedurally timely. However, the amount she can recover is strictly limited by the lookback rule. Because Julie had a valid extension on file, her lookback period is 3 years plus the 6-month extension period, measured backward from her claim date of October 28th, 2026. This 42-month lookback window reaches back to a cutoff date of April 20th, 2023. Any taxes paid prior to this cutoff date cannot be refunded. Julie's $2,000 in estimated tax payments are legally deemed paid on the original due date of April 15th, 2023, which falls prior to the lookback window cutoff. Therefore, that money is permanently lost. She may only recover the $600 paid on October 28th, 2023, as it was paid strictly within the permitted time frame. And that officially wraps up Domain 1 completely. Fantastic work pushing through all 30 questions today. We covered some genuinely advanced material: backup withholding for non-resident aliens, statute of limitations for both refunds and IRS assessments, filing requirements across different taxpayer situations, spousal relief provisions, the IRS lookback rule, and even the legal standard for criminal tax evasion. If you're comfortable with everything we've covered across all four Domain 1 tests, you've built a genuinely strong foundation for this section of the exam. Now I'd love to hear from you. Drop your score out of 30 in the comments below. And since this was our last Domain 1 test, let me know your overall journey. How did you do across all four tests in this series? Quick reminder, if you want structured chapter wise practice for every topic in part 1, exactly like what we've covered across this entire Domain 1 series, you can go with my ebook. It's organized chapter by chapter with detailed explanations so you can strengthen any specific topic at your own pace whenever you need it. Link is in the description, and here's what's coming next. Since we've now completed Domain 1, our next test is going to be something bigger. We are putting together a full mixed syllabus practice test covering all of Part 1, 100 questions pulled from every topic across the entire syllabus. So, if you want to test your overall readiness across everything we've covered so far, that one's going to be a great benchmark. Make sure you're subscribed so you don't miss it. If today's session helped you, do hit that like button. And thank you so much for sticking with this entire Domain 1 series. Keep showing up, keep practicing. I'll see you in the next test. Until then, take care and keep grinding.